In this video, I'm going to explain how to commit frauds like a pro. I'm joking. In this video, I'm going to reveal the 3 most common type of fraud in the world of commodity trade finance. So if you are involved in the commodity trading industry in any shape, way, or form, you should know that this is a practice that you may encounter. But before diving into the explanation, there is something that is extremely important to understand when we speak about commodity trade finance fraud. In international trade, fraud would be sending containers and there are painted rocks instead of copper cathode. Those type of fraud are completely stupid, as you are going to have a time bomb above your head, you are going to get caught. We know it's you. It's pretty obvious. In trade finance, on the other hand, the frauds are less obvious and well executed. There is a good chance that you are not going to get caught. Here is what I wrote on LinkedIn. And by the way, follow me on LinkedIn. I do my best to write daily on it. In most trade fraud cases, the liquidity is the commodity being traded between counterparties. So what does this cryptic message mean? In most commodity trade fraud cases, the idea is not to steal the money and run away with it like a moron, but to be able to borrow more money from the lenders. More money means more liquidity, which means more deal possible, and at the end of the day, more money in the pocket. And if the fraudster managed to get the money back to the lenders with the fees and so on, there's a good chance that they are not going to get caught. Got it? And actually, right now, we are in a vicious cycle in terms of liquidity available for traders. As the banks are pulling away from CTF lending, there is less liquidity. So there is more risk that a company commits fraud because they need liquidity. So it draws away more banks and lenders, which create even less liquidity, and so on. So let's start with the most common type of fraud. And then the more we advance in the video, the more complex the frauds become. To understand what a multiple pledge is, let's start first by understanding what a pledge is. A commodity pledge is a loan where you use a commodity that you own, such as a stockpile of grain, as collateral to obtain the loan. Let's say that you need to borrow $500. You don't have the cash, but you do have wheat stored in your barn that is worth $1,000. You could approach a lender and pledge your wheat, essentially saying that if I don't pay you back the $500 plus the yield, you can keep and sell my wheat. The lenders then give you the $500 and keeps a legal hold on your wheat until you pay back the money. If you can't pay it back, they can take your wheat and sell it to cover the cost of the loan. If you manage to pay it back, the hold on your wheat is released. So a pledge is when you have one collateral, let's say a stockpile of aluminum in a warehouse, and you use this collateral to get a loan. Now, this fraud is pretty simple to understand. The multiple pledge fraud is when you use one stockpile, one collateral, and pledge it to multiple lenders. So if the borrower disappears, like most dishonest, then who is the rightful owner of the cargo? So if you look a bit online, you'll find dozens and dozens of frauds like that. Mostly in China, but seriously, it happens everywhere. Here, it's starting to be a little more complex, so let's switch on PowerPoint mode. Here is a normal transaction. You buy FOB from your supplier and you sell a DDP to your client. And by the way, if you wonder what FOB means or DDP means, please check the first link in the description below. There is a Shipping and Commodity Academy where you are going to learn everything about this wonderful world of commodity trading. Now, here comes the ghost transaction. The fraudster will use the bill of lading of the legit transaction, comes up with a fake client and a fake sales contract, and then get the ghost transaction financed by another lenders. Ta-da! Here is another fraudish way to conduct business. In some companies, traders are asked to report the value of their stock at destination or at origin. And you know we are in the commodity trading business, so the value of those stocks will fluctuate with the market price. For some commodities, you can hedge for sure, but in a lot of cases, it's impossible to hedge those stocks. So basically, you need to be an expert of this destination market or this origin market to really know what is the correct price of your stock. So here comes the fraud. When you have to report the value of your stock for your borrowing days, for instance, some traders will overvalue their stock to be able to borrow more money. As I said, it could be quite difficult to assess the fair market value of those stocks. And now a question would be, what is a borrowing base? A borrowing base is a method used by lenders to determine how much they could safely lend to a company. It's based on the value of the company's assets, stock, and receivables. The money carousel is a way to artificially increase the revenue of a company with fake transactions. It's not really a fraud to make money straightforward, but if you are able to show growth year over year of your revenue, then you are more likely to get a credit line by lenders. That's pretty much it. Especially that most of the lenders only look at your revenue. Even though they said they look at other parameters, come on, I know that they only look at your revenue. So let's say that you have a normal transaction, a supplier, a buyer. Now you negotiate to have 30 days to pay after shipment. Then the money carousel is this. The principal trading firm is going to agree with a few other trading firms to purchase and sell the good between each other for almost no profit. So then every company could boost their overall revenue. Nice, huh? So to sum up, the commodity trade finance fraud are often fraud to borrow more money, not to outright steal money from the lenders. And honestly, usually those type of fraud are not easily undercoverable, are not easy to spot when the market is up. And this is why the fraudster gets more comfortable and then he borrows more and more money. And when the market shifts, the guy is completely over-leveraged and the loss becomes unsustainable and the fraud is discovered. So that's it for me today. I hope that you liked the video and that you learned something. And if you want to know more about the world of commodity trade finance, which is basically how to finance commodity, I have a bunch of other videos that you should see somewhere on the screen. Ciao!